A new mining act may shake up the mining sector. Low job openings in the US, but a higher probability of a Fed rate cut in September. And as always, what should you, as intelligent investors, watch out for this week? Let's dive right in. Another week is another opportunity. Hi everyone and welcome to Intelligent Investing with me, April Tan, Chief Equity Strategist of COL Financial. The local stock market barely moved last week as the PSEi closed at 6,149.13, down just 0.1% week on week. Trading volume was very light at only 5.2 billion pesos per day, much lower than the year-to-date average of about 7 billion pesos. Market breadth was slightly positive with 137 gainers against 130 losers, but foreign investors continued to sell, unloading another 1.6 billion pesos worth of stocks. One of the biggest macro stories came from the US labor market, as the number of job openings fell to 7.18 million in July, missing expectations, while August non-farm payrolls rose to only 22,000, far below the 75,000 forecast. In fact, June was revised into a net job loss of about 13,000. Because of these weak numbers, the market is now assigning an 89% probability of a Fed rate cut in September, with a total of 75 basis points of cuts expected by year-end. Since a few years back, there were already signs of a weakening labor market. For example, the unemployment rate has been climbing up since last year, although creeping up slowly. But the thing is, the non-farm payrolls, they will always come out with a strong number that would beat expectations. Like, yun na nga, like last year, you'd get 300,000, 200,000 plus. So that is what people are really focused on. But there were a lot of signs already that it's weakening, except, most investors and the Fed is focused on the non-farm payrolls. Okay, so what happened to the non-farm payrolls? Only this year, we saw it slowing down. But before that, there were so much downward revisions, except nga this time around, the downward revision was so steep that, for example, for the month of June, there was a net decline. In the past, they would bring it down, but it's still positive 100 plus thousand, etc., etc. Well, on the one hand, you have the Fed rate cuts because the Fed has a dual mandate. One is full employment and another is inflation. So because of what's happening in the job market, even though inflation in the US could still go up because of the Trump tariffs, the focus will now shift to the labor market because it seems to be a bigger problem. So looks like they will be forced to cut interest rates, which theoretically should be good news, right? My concern, though, is that instead of the interest rates cut being viewed as a positive is what is the reason why, interest rates are being cut? Because if the economy really is weak, then it could send the US market going down because that has happened in the past. Every time the US economy suffers from a recession, the US market goes down, especially right now, the US trading at such an expensive valuation, and Philippines could suffer from a contagion. Here at home, August inflation was surprisingly higher than expectations at 1.5% versus 1.2%. But investors largely shrugged it off as the uptick was mainly due to bad weather pushing up prices of fish and vegetables, something that could reverse in the coming months. I think in general, investors should be excited because if you think about it, the BSP, in a way, is hampered from what it can do as far as interest rates are concerned. One of the things that they look at really is the interest rate differential with the US. They cannot cut interest rates too much such that, the differential between the dollar interest rate is so low. If that happens, then the peso would suffer from a massive depreciation. So if the US is cutting rates as well, then the differential with the US will be much wider. So the BSP can act more independently and just focus on economic conditions in the Philippines and inflation in determining how deep it can reduce interest rates locally. Let's say even if the Philippine economy is having difficulties, they cannot cut rates because they have to be worried about the forex volatility otherwise. Last week, President Marcos signed Republic Act 12253, or the Enhanced Fiscal Regime for Large-Scale Metallic Mining Act, into law, introducing a new taxation system for large-scale metallic miners. How it works is if a company operates outside mineral reservations, it now faces a 1% to 5% royalty based on operating margins, with at least 0.1% of gross output even if unprofitable. And for those inside mineral reservations, the 5% royalty on gross output stays. On top of this, there's a new windfall profit tax. Once margins hit 30%, taxes start at 1% and rise to as high as 10% if margins exceed 75%. The goal is to give the government fiscal certainty in collecting revenues while still being less punitive than earlier proposals, which included even higher rates. COL's mining analyst George Ching highlighted that the law will significantly affect NIKL Asia, since their mines Rio Tuba and Bulanhao, which are outside reservations, will now pay royalties. But their mines like Taganito, Manicani, and Dinapigue, which are already inside reservations, will stay the same. But with margins above 30%, all of NIKL's mines will be subject to the windfall tax. As a result, NIKL's 2026 profits are projected to drop by 9.4% to 5 billion pesos, cutting its fair value estimate by 5.3% to 4.15. Other active miners like Apex Mining and OceanaGold Philippines will also feel the pinch. Their mines sit outside reservations and their margins are well above 30% thanks to high gold prices, so both royalties and windfall taxes apply. In contrast, Semirara is unaffected because it's under the Department of Energy, not the DENR's metallic mining framework. On one hand, RA 12253 raises costs and could dent profits across the industry, which makes companies like NIKL, Apex, and OGP less attractive in the near term. But on the positive side, it introduces clarity. Investors now have a predictable framework for how mining revenues will be taxed. That reduces uncertainty, especially for long-term budget planning and project financing, which the government hopes will help the country attract more investments into the mining sector. Again, in the short term, they will be taxed more. But in the long term kasi, the problem is the government has been talking about taxing mining companies for a very long time, even before the late Gina Lopez passed away, because she was an environmentalist, diba? So it's been around, and there are many lawmakers who want to tax these miners because if you think about it, they're just digging the ground and just selling whatever they get. So in a way, it seems kind of unfair. But the problem is, if I'm a miner and I don't know how much the government will tax me, I cannot determine whether a certain level of investment is warranted. What if I already spend that much money on making these mines or developing these mines, and all of a sudden the official tax comes about and I can't make any money. So having this clarity, this certainty that the government will only collect so much helps me as a miner, for example, determine whether a project is feasible or not. I mean, hopefully that would also help the government generate revenues. They say nga the Philippines actually has a lot of minerals. We are not able to harness or maximize. Now that we have regulations which seem strict, at least we can still capitalize on the high gold prices right now. So if I'm a mining company, as long as, okay, I factor in all the costs, I can still make more, then I'll probably expand my operations. At the end of the day, whether you view this law as a risk or as an opportunity depends on your perspective. Lower profits now, but better policy stability and potentially greater opportunity for growth going forward. Now, let's look at the different sectors which had mixed results. Property and REITs gained on expectations of lower interest rates. C-REIT up 4.3%, Ayala Land up 3.2%, and RLC up 1.5%. Gold miners rallied as gold hit another record at $3,587 per ounce. Standout gainers include Lepanto, Apex, and Philex. On the downside, the big three banks, BDO, BPI, and Metrobank all slipped as lower interest rates are expected to hurt their net interest margins. The worst performer was PREIT, which crashed 39% after the Energy Regulatory Commission ordered the shutdown of Siquijor Island Power, a key tenant that accounts for about half of its rental income. That's it for this week. All eyes will be on the U.S. market's reaction to the weak jobs data. While softer employment strengthens the case for Fed rate cuts, it also raises fears of a U.S. recession, something that could weigh on global sentiment, including here in the Philippines. Another week is another opportunity. Don't forget to like and subscribe so you're the first to know what's moving the market. Once again, I'm April Tan. Another week is another opportunity. Stay sharp, stay selective, and as always, invest intelligently.